I wanted to get behind a video and show you what I'm seeing in the market. I used to exclusively only do video because writing with my dyslexic brain is just too hard to get all the information out. And there's so much I want to share with you right now that I'm going to go back to the video format simply for me to get the information out to you. So I hope you find this useful. And I'm not actually sure what you're going to find most useful, how I quickly go through the 4 core assets and really show you what's going on, or how they really interplay against each other and how it's actually the 4 assets and how they work with and against each other that is the biggest determinant of how well your portfolio grows, right? And not your age or your self-described risk tolerance. So every chart I'm going to show you is an open, high, low, close chart. The blue line is a 200-day exponential moving average. And this little thumbnail over here is just literally a zoom in on what we're seeing right over here. But the main part of what I want you to really notice is the blue line and these open, high, low closes. So this is the S&P 500. It has fallen 20%. Down here you can see that the 20% line was defended. And the reason why this 20% loss is important is because people think it's important. So whether you think a bear market starts at negative 20% or not actually doesn't matter. What's most important is the world of investors do believe that 20% loss matters. And so when the market fell, the S&P 500 fell down 20%, it was defended. And the market was up 5% the following day. Now, I want you to know when the market moves 5% up or down in a day, that is a sign of unhealthiness. It is never a good sign when the market goes up 5% or down. And you'll see those type of huge moves when the price of the market is below its 200-day moving average, which, as you can see, the blue line in this case is the 200-day exponential moving average. So this market is in fact getting weaker. The other thing I wanted to point out on this price chart is when the market did try to go back up to this February, March, April old support line between these two blue horizontal lines, you can see that over here, it tried to get back up through that and it got pushed lower. As long as the S&P 500 is below those February, March, April lows, you have to have more of a bearish tint or slant than not, because that is going to be one of the first areas for the price to have to break through. Now, if it does break through, it doesn't mean that the correction or the mending is over. It just simply gives you a price point to say, okay, if we're below that February low, then the bears are in control more than not. And if we're above that February low, then the bulls might be more in control. It's just simply a point for you to know more positive or more negative. Now, it's very likely this market will test its 20% low point again back on December 24th. The next price chart I want to show you is still the S&P 500 with dividends reinvested. I just want to zoom out a little bit, in this case, 5.5 years. Now, just simply, this is the same thing we were looking at, the 20% down right here that was defended. So if the price does break below that defended 20% loss, there's not a lot below it until it drops to 32%. So from the high in September, there is a high likelihood that the market's going to want to drop about 32% down to its 2015 and 2016 price point that it could not get above. So if you look here, the two blue horizontal lines, the S&P with dividends reinvested could not break above these two horizontal blue lines. And when they finally did, it moved higher. So there's a high likelihood that if the market does break below this 20% loss, there's a lot of space below it to fall down to a total of 32%. Now, it is not unlikely for the market to fall 20 to 35% during a correction when there is no recession. So as of right now, we don't have a recession. Now, we only know in hindsight that we do have a recession, but a 20 to 35% correction without a recession is something that happens from time to time, meaning it is part of the health of the stock market. Now, we don't know where the market's going to go. It could stop where it is and move higher and mend itself. If so, the average time the market takes to heal itself when it does fall 20% is about a year. So there's definitely some mending, even if we have seen the low. But based on what I'm seeing, it does not look like the lows are in. Okay, now this is important just to give you an idea of what could happen. The next thing I want to look at is Treasuries. Now, the case or the way that I want to look at it is with this iShares ETF, 7 to 10 year Treasury bond ETF. What I want to point out, and really what I was looking at myself, is what should we expect? Now, one of the first things I want to point out to you with this, and this is, again, a ETF tracking the 7 to 10 year government bond. One of the first things I want to point out is people are really moving into the bond market now. Back when we had the 10% correction earlier in 2018, that correction basically was about between these two vertical blue lines. Notice money did not move into the bond market. In fact, money did not move into the bond market really until November and December. That's when it really moved into it and kind of broke above this resistance. And then it started moving higher. Now, here's something that's interesting. The European Central Bank came out in October and said, we are going to stop our money printing. Okay, now they obviously don't use the phrase or the term money printing. They call it their asset purchase programs. But they said in October that we're going to stop our asset purchase programs. We're going to stop printing that money. And they said we're going to stop printing all the money on December 13th. So let me find December 13th. If you can look on my screen and see the vertical gray line, that's December 13th. Note, and I'm just going to do two blue verticals so you can see between there. You can see when the money printing stopped in Europe, this bond price really skyrocketed higher and is moving higher. So this is an example where money printing stopped and people are getting concerned. And one of the ideas is if money printing helped the market go up the last 9 years, the Fed has stopped its printing, stopped it at the end of 2016, and now the European Central Bank has stopped their printing. So people are now moving into the bond market, unlike the correction at the beginning of 2018, which I talked about when we were in that correction. I said, this is just a correction. It's just a price correction. No one is changing how they're behaving with their investing. And then I came out and said, this correction is a much different correction. And in fact, you should expect much more volatility. And we're seeing that in the price charts. The next price chart I want to show you is the US dollar. Now, back in 2018, at the beginning of the year when it had its first 10% correction, you can see between these two blue vertical lines that money did not move into the US dollar. And it really didn't start moving in until April, May. And has been money has been moving into the US dollar since then. Now, the market peaked again, and I just want to get to April 21st is the first blue vertical line, the one on the left. That's when the S&P stopped going higher and started moving lower. So you can see that money is still moving into US dollars. Now, it has been moving into US dollars since April, May. The difference now is that money is continuing to move into US dollars. And now, unlike the correction at the beginning of 2018, this correction we're in right now, money is also moving into bonds. So now you have two asset classes that people are voting on over the stock market. And that is a significant and noticeable thing that you must take note to. Okay, now if I'm going fast, you can just rewind this and listen to it again. The next chart I want to show you is the Commodity Research Bureau, or basically the SP 500 of, hold on, let me just get this in line here. The SP 500 of commodities here. So back at the correction beginning of 2018, commodities were trending higher. Again, the exponential 200-day moving average was moving higher. That all changed in October. Again, this could have been also with the European Central Bank saying we're going to stop all of our money printing. But you can see here this huge crash, correction, fall, collapse, fill in the words you want. It's definitely a move down. The majority of the reason this fell is because of the 45% drop in the price of oil. So then the question is, what is oil looking at into the future? What is it worrying about? Is it worrying about the world economy? Is it worrying about the world economy slowing down? But a 45% drop in oil is not a trivial drop. Plus, how fast it did. Now, this is not a price chart of oil. This is a price chart of the entire commodity complex. But you can see how people are not moving into the kind of global commodity. So we know that people are moving into US dollars, and we know people are moving into US government bonds. The biggest takeaway is just noticing where money is flowing, noticing where people are changing their vote. What are they voting on? Because that matters most. Okay, I have 3 more charts I want to show you. This next chart I want to call it, is this the next Lehman Brothers? Now, I'm saying that not wanting to be hypey, but really honestly saying, is this the next Lehman Brothers we're looking at? So the price chart you're looking at right here is the 15th largest bank on the planet. It's Deutsche Bank. It's the 15th largest bank on the planet from an assets point of view. It's the 4th largest bank in Europe if you include the UK with Europe. Some would include it, some would not. If you don't include the UK as being part of Europe now because of the Brexit, what you're looking at is the 3rd largest bank in Europe and the 1st largest, or the biggest bank in Germany. So to my brain and to my eyes, this price chart looks like it's going to 0. And if we were to take this and compare it to the overall German stock market, we would see, I'm not going to do that, but I'm just telling you, we would see that Deutsche Bank has been underperforming the German stock market for 12 years, over a decade. There is a lot of pain going on right now in this bank, and it would not be surprising to me if this became the next Lehman Brothers. And in fact, is this what the market is looking at? And if you look at this screen, though it is zoomed out to 10 and a half years, you can also see with my blue, I'll do 2 blue vertical lines here. You can see that it really accelerated to the downside when the European bank, or after the European bank said, hey, we're going to stop our money printing finally. And man, this price looks like really it is in a free fall. So what happens to the stock market when not only the largest central bank on the planet, that is the Fed, now they said they stopped printing their money in October of last year. But now you have the 2nd largest central bank on the planet and the central bank that's in charge of the largest economic bloc on the planet coming out and saying, hey, we're not going to print money anymore. So people are taking note, people are changing their vote, and it's very likely that this literally could be the next Lehman Brothers, or the European version of Lehman Brothers, and the market is starting to price in the likelihood of the largest German bank going under, or the 3rd largest European bank going under, or the 15th largest bank on the planet going under or going to 0, and this is what it's looking at. Okay, 2 more. Now, I wanted to show you the Chinese, specifically the Shanghai Stock Exchange, or the Chinese stock market, because it is breaking down, and it's about to. Now, I don't know if it's going to do this, but it looks like it's going to break down to new 4-year lows. And that's important because China is the 2nd largest economy on the planet. There is a trade war going on right now between the US and China, and it looks like both of those countries are losing. China is losing more, and if it breaks below this low right here, there's a lot of space below for the Shanghai Stock Exchange to continue falling. And as it is, from the high point of its 2018 to where it is right now, it's down 32%. That is a noticeable and significant fall. And again, if you go back and look, well, You have October, where the European Central Bank said they're going to stop printing. But the area where, or the date where the European Central Bank actually stopped printing was December 13th. Which, if you can, let me see if I can kind of get it between those. So again, you have the printing ending actually on December 13th, and the Shanghai Stock Exchange did a big step down. Lastly, I want to show you something here between corporate debt. Hold on a second here. Let me just get the best view here. So this is corporate debt versus government debt, and the government debt we're looking at is US government debt. If the black open, high, low, close is falling, that means people are voting for safe debt, US government debt, those 7 to 10 year government bonds, over corporate debt. And the blue line again is the 200-day exponential moving average. So people are buying safe debt over corporate debt. And again, you have the European Central Bank coming out in October saying, we're going to stop printing money. And they were buying corporate debt. But then you look to the exact day here. I'm going to just bracket it by the two vertical lines. Once the European Central Bank actually stopped their printing, which was December 13th, which is right between these two vertical lines, you could see that people voting for safe debt over corporate debt absolutely accelerated, right? Because again, when the black open, high, low, close line is falling, people are saying, no, I really want the safer debt. If I have to own debt, I'm going to buy safer debt. And so what you're seeing potentially is an unwinding of the European Central Bank printing their money. And it's not only affecting corporate over bonds, but it's affecting the Shanghai Stock Exchange. It's affecting Deutsche Bank. It's looking at and affecting the Commodity Research Bureau, or basically the entire basket of commodities. And this is the market we have. I'm going back here to the SP 500 with dividends reinvested. This is what we have right now. And so I've given you the price points to take note and make note of. But here's the thing, you have lots of choices, right? You don't have to stay the course and take a full hit on your money. There are places to move your money where it doesn't have to get hurt, right? And just in this short video, I've shown you where there are places of stability in the investment world. And those places of stability are getting more and more stable. So if you find yourself in newsletter overwhelm, or if you find yourself not being able to take action, or if you find yourself wanting to really know how to implement best, then perhaps maybe the next easiest or simplest step is to just get on my calendar and say, RC, how can you best help me? Thank you guys for being in my world. I hope this video helps you get clarity on where the market might be heading next, and I will speak to you soon. Again, this is RC Peck